Hello and welcome to Macro Bites, the economics and politics podcast from Aberdeen. My name is Paul Diggle, Chief Economist at Aberdeen.
And I'm Luke Bartholomew, Senior Economist at Aberdeen.
And today we are talking about the US economy and some of the crucial debates in macro markets at the moment. Things like the drivers of benign disinflation over the past year in the US, whether this can continue, whether the last mile of bringing inflation back to the 2% target is going to prove the hardest, the risks of a repeat of the 1970s experience of inflation pressures re-emerging, and whether markets should be worried both about inflation dynamics, but also the size of US deficit and debt. So we're delighted to be joined by Aberdeen Deputy Chief Economist James McCann to talk about all these issues. Welcome, James.
Thank you very much for having me.
So, James, 2024 started in markets with a lot of optimism about the remarkable progress the US economy, the Fed, had made on bringing inflation down, annualizing the run rates of sequential PCE inflation over 3 6-month time horizons seemed to suggest the job had basically been done. And at one point, the financial markets were very confident in rate cuts beginning from March. But that narrative has taken a bit of a battering in recent weeks. Can you talk us through the latest inflation numbers in the US and what they might be saying about the last mile of lowering inflation?
Absolutely. And I think it's probably worth just providing a very quick introduction for those who aren't avid followers of US inflation data about the different measures that the Fed looks at and focuses on. The classic measure of inflation, of course, is CPI inflation. That's what economists talk about most commonly, a basket of goods and services and a measurement of prices across those. The Fed looks very closely at something called PCE inflation, which is very similar in many ways. It's a basket of prices across a range of goods and services as well. The difference is the survey method. It asks businesses what price they receive rather than consumers what price they pay. And then secondly, it has a number of different compositional methodological differences. So it's a broader measure. It incorporates a larger range of goods and services that consumers buy. It has different weights as well within it based on that difference in scope. And then there's some more technical aspects around how the index is calculated that I won't get into. But having just provided that little bit of context, you're absolutely right. That PCE measure, which of course is the Fed's target, in the 6 months over the second half of last year, that had fallen to 1.9% annualized. So basically at even a tiny bit below the Fed's target in core terms, that is. So remarkable progress. Core CPI had fallen too, but not by quite as much. So core CPI at the end of last year, 6-month annualized, was running at 3.3. Still well down, but not as impressively. The bad news, I suppose, for the Fed is that core CPI is continuing to come in hot in early 2024. We saw the headline number beat expectations, and the breakdown of it was relatively unfavorable. So despite another large decline in core goods prices, we saw pretty hot core services prices. And we can map across some of the core CPI information into the PCE information. And that tells us that actually core PCE in January is almost certain to accelerate to above target consistent rates. Now, this is just 1 month, but it's a bit of a knock in that disinflation narrative. It maybe tells the markets that the path lower inflation, the last mile of inflation, will be a little bit bumpier than they might have hoped for.
And there are obviously a lot of moving parts in the inflation numbers, but particularly in those core services numbers, some of the subcomponents that markets are really lasered in on are rents, medical costs, and then more broadly, how wages feed into inflation. Could you talk a little bit about what those moving parts are doing?
Absolutely. And we've long been expecting, and the market has long been expecting, rental inflation to start to moderate. It's been running at very, very high rates, and it has been slowing to some extent. But when we look at other indicators of rents, private sector indicators of rents, they're very clearly cooled. The housing market itself, so house prices themselves have cooled. And there's been an expectation that will feed into the core CPI and the core PCE rental dynamics. That's not yet coming through. And I think, again, that core CPI showed very, 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 very strong owners equivalent rents. So That's an unusual component. It's one where you ask people who own their own homes how much they'd have to rent them for. So it tends to be a little bit more slow to update because people aren't tracking the housing market as closely. But the concern is that people have baked in that rental inflation will slow, and we do think it will slow. But again, an example of a little bit more bumpiness that's perhaps taking a little bit longer to feed through. And then there's concern too about medical care services. That's a really important part of PCE inflation. The partial data also from the PPI report, that's another inflation measure to throw into the mix. That was released that was released last week for January. That measures inflation one step earlier in the chain. So the prices that producers, wholesalers receive for their goods and services, that indicated that medical care services was inflation was going to come in relatively hot in January too. The core CPI doesn't pick that up as thoroughly. That's one of the differences in the scope measures there. So some lingering concerns that you'll maybe get a bit more on medical care services as well. Another aspect of that services inflation proving difficult. And really for the Fed, they look at headline inflation, they look at core inflation. They don't want to get too distracted by some of these exclusion measures. But the fear for them might be, I suppose, that they're getting a lot of good news on goods prices, and that's covering up some of the strength in services prices, which is okay because they look at the baskets as a whole, or at least large portions of the baskets. Their fear might be if that goods price deflation starts to evaporate, then actually inflation might be running too hot. You mentioned wages there. I think, one light at the end of the tunnel is that wage measures are clearly moderating. So if they look at that as a forward-looking indicator of where these core prices might move, then that's an encouraging sign that domestically generated inflation is cooling. But yeah, I think the main message is it's just a reminder that some of this process might be non-linear, it might be bumpy, might be not as smooth and quick as the market had been hoping for.
And perhaps some of that concern on if the goods disinflation kind of dries up a little bit, that feeds in or interrelates with events in the Red Sea as well. A lot of the favourable unwinding post-pandemic of supply chain disruptions, some of that is reversed a little bit. We think it's more of a European than a US issue, but I suppose that's also a lingering concern that might be in the mix.
So just to pick up on this last mile phrase that we've mentioned a few times now, because I guess that was a phrase that's been introduced into the discourse by policymakers. It's a mantra that they've been repeating quite a lot, the idea being that there might be something particularly difficult about the last mile of squeezing inflation out of the system. And I guess the idea of the rhetoric is that central banks will be willing to travel this last mile regardless of how difficult it might be. But I'm sort of wondering where they got the idea that the last mile might be so difficult, James. I mean, notwithstanding some of the bumpiness that you described there, I don't think it's intrinsically obvious that, say, getting inflation from 3 to 2% should be that much more difficult from getting it from, say, 4 to 3%. So A, where this idea comes from, and B, the fact that central banks have been so keen to keep on reinforcing this last mile, it could be difficult, but we'll travel it message. Does that tell us something about their reaction functions and willingness to perhaps commit the policy error of keeping policy too tight for too long to ensure inflation doesn't pick up and therefore cause a recession, rather than the policy error of maybe taking their foot off the brakes too early and allowing inflation to pick up again?
Yeah, I think these are really important and good questions in terms of that. Is the last mile of inflation harder? The IMF, another important part of the policy community, have been banging this drum. I suppose you could argue that some of the early yards of disinflation were maybe easier based on global supply chains figuring themselves out, energy price inflation starting to come out of the system and the associated knock-on effects of that sort of broader goods price dynamic. And it could be the case that it's the services aspect that is stickier, that's harder to shake out, requires more disruption. That could be one plausible argument. I would say US labour market has looked to be cooling in a relatively benign manner. And as we mentioned, those wage costs have come down, much more easily than I had anticipated. I had thought that would require more of a shakeout in the labour market to see that moderation. So, I think there's a strong degree of policy consensus around it, or certainly a significant fear around it. I'm not certain it will turn out to be the case, but certainly there seems to be a degree of conservatism among central banks in that direction. Thinking about the motivation for that and the relative risks, this is something that the Chair Powell talks about a lot, that risks are now finally balanced for the FOMC between seeing inflation continue to surprise above target versus doing too much to undermine the US growth and labor market environment. Perhaps from the Fed's perspective, it's not seeing many red alarms, red lights on the latter. So it feels it has the room to go and be really careful about this last leg of inflation when it sees initial claims at extremely low levels, when it sees payroll growth coming in at robust rates. It feels maybe it has the luxury to be a bit more cautious around the last mile of inflation and hold policy tighter for a little longer. Time will tell if that turns out to be a policy mistake. It's not impossible that the data turn on them and they feel that they missed a window here, but from the best information that's available to them at the moment, maybe they think there's a degree of time. More broadly, maybe they feel a degree of humility, having had issues with their inflation forecasting, like many of us over recent years, and they don't want to take anything for granted, and maybe an element of conservatism too around inflation risks and a disproportionate fear of that relative to their mandate. That's maybe more speculative, but yeah, I think it's an important question. And I think the really interesting thing is, how would the Fed react if you were to start to see some more red lights going off on the growth front? How would that caution on the last mile change? How would they balance that? I think that's quite an interesting question.
So perhaps just to add a little bit more speculation as to what could be behind the central bank's view on the balance of risks, that perhaps one risk that they're alert to is being judged by economic history in much the same way as Arthur Burns and the Fed of the 1970s was haunted by this experience of letting inflation seemingly get out of control in that decade. And, there was a chart going around for a while, perhaps a bit of a chart crime, but a chart nonetheless showing the 1970s inflation experience and overlaying our recent one, and what the 1970s decade of high inflation, describing it in that way, sort of loses is that really what happened is inflation went up, it went down, and then went back up again as these shocks came through. And perhaps it's sort of this concern about reliving that kind of experience of seeming like you've won the battle, only then to see inflation pick up again, that's haunting central banks as well.
Yeah, much better in their mind to be Paul Volcker than Arthur Burns. But that said, James, you obviously highlight that the growth rate has remained very resilient even as inflation has come down a lot. So you're not having to do what Volcker did and impose a very weak growth environment, a recession, to bring down inflation. Actually, what seems to have occurred is a big positive supply side shock in the US economy. That's the organizing principle that economists call the combination of strong growth and lower inflation. But what specifically has driven supply side improvements in the US?
There have been a number of, as you say, of favorable tailwinds coming in at the same time. The most, I suppose, immediate of those was an unblocking of global supply chains that allowed the goods sector to kick back into gear, so to speak. I don't think that was an enormous positive tailwind, but it was something important to note. I think that the real impetus, though, has come more through the labour market. We've seen labour supply increase very noticeably over the last 12 months or so, driven by a combination of stronger immigration flows. Immigration was significantly held up during the pandemic by all the restrictions on movement and delays in visa processing, etc. And those have improved. Those backlogs have started to come through, and immigration's rebounded very, very smartly. And then similarly for those in the US labour market, more are participating, or at least those in the US, more are participating in the labour market. We've seen the prime participation rate rise to multi-decade highs. And that, of course, was following a multi-year shock after the pandemic, where people left the labour force for various reasons, be it childcare, be it concerns over public safety and health, etc. So that sort of positive tailwind has been quite important in helping cool the labour market without that need for very, significant demand destruction on the labour demand side. I think another dynamic that's been important too has been productivity's improved very, very noticeably. So, productivity accelerated at the end of last year to 2.6% in year-on-year terms. To put that into context, productivity numbers get thrown around during recession, so we should exclude that. But excluding those dynamics, that's the strongest we've seen since the early 2000s. And of course, that was a stronger productivity era compared to the sort of post-GFC environment where productivity was very subdued. So I think some final shakeout of some of the pandemic hangovers and scars has been quite important in driving that. And again, productivity is important because it means that even if wage costs are running at high levels, it's not as impactful for firms' bottom lines. They can absorb more of that without having to cut their margins or having to push higher prices onto consumers. So, there have been a few positive supply shocks, and they've been probably more powerful than we had expected, certainly 12 months ago. And I think they've really helped facilitate this combination of strong growth and slowing inflation.
Yeah, I think it's interesting to ask why the US had those positive supply shocks in abundance, but by contrast, the likes of the UK, the Eurozone didn't. They have seen inflation moderate quite significantly, but at the same time, growth has moderated and indeed slipped into recession in the UK and bumping around zero in the Eurozone. And those economies did get some of those positive supply shocks, particularly the global ones you're talking about, James, lower commodity prices, supply chain improvements. They also, to some extent, got this, what economists would call the inward shift of the beverage curve, which is basically an improved job matching function in the labour market, matching up people in unemployment with job vacancies. But it just seems like the US got those things to a much larger extent. For example, the US didn't have to deal with the large run-up in commodity prices triggered by, obviously, the Russian invasion of Ukraine. But I think the productivity performance must be the really big difference maker, as you highlight. And I wonder why that is. I mean, is it because the US is at the technological frontier, so early benefits of AI have already been felt in the US economy? Is it a legacy of Biden-era policies like the CHIPS Act, the Inflation Reduction Act, raising R&D and investment? Is it a legacy of labour market policies during the pandemic, which encouraged labour hoarding in Europe, but perhaps creative destruction in the US? I mean, any thoughts on why the US got this tailwind to such a greater extent?
Yeah, if we compare the trend in productivity, what this recovery has done has been put you right back on your pre-pandemic trend, and I think that's the stark contrast that you look at other developed economies and some emerging economies too. They're still languishing well below that trend. I think my instinct then is to think that some of the pandemic responses, while by no means perfect, maybe have helped weather some of that shock or correct that hangover, see the US through that hangover, whereas other economies maybe haven't got there. So, as you said, maybe pointing to aspects of the labour and product market responses, the combination of very, very strong demand side stimulus, which arguably had its downside in a period of higher inflation, but maybe prevented some of that supply damage through the pandemic from becoming more permanent. These are things that I might speculate on. I probably would flag at the moment where speculation. It'll probably take many years before people fully figure out what was at the root of this. I think the AI one is really interesting. If I think forward about can the US maintain this level of this rate of productivity growth, and I think you are having now, probably given that you've returned back to your pre-pandemic trend, having to become more optimistic on the run rate of future productivity growth. So you'd have to draw in, a hope or expectation that AI is unlocking, faster productivity, labor output across the economy. Possibly. Normally we tend to see, as I think you folks have spoken in this podcast before, we normally tend to see the benefits of this type of technological revolution take longer to materialize, but it's not impossible, and keep your mind open to that, certainly because the supply side has probably been the area of the economy that surprised us most in the last 12 to 18 months.
So looking forward then, James, and outside of productivity, I mean, are there potential avenues for these supply side improvements to continue, or has this run its course? I mean, it seems to me, for example, that the beverage curve, as Paul described it there, this reflecting the efficiency of labour market matching, having moved back to its pre-pandemic levels. Is there really scope for that to continue to improve, or global supply chains that have subsequently unsnagged after the COVID disruptions? If anything, now they might be going in the wrong direction due to the Red Sea. So, from what was a huge tailwind last year, these positive supply developments, I mean, is it possible that they could be turning into headwinds even for this year and beyond?
Well, I certainly think it's possible that some of them have run their course, and I think you've outlined a couple there. Absolutely on the global supply chain dynamic towards the second half of last year. Measures that try and capture all aspects of that, freight costs, commodity prices, etc. They were showing that supply chains were functioning and back to normal. And as you say, if anything, the risk has moved to further disruption based on disruptions in the Middle East. So I think that's one which has certainly run its course. I think the efficiency of the labour market, as measured by the beverage curve, unless we assume an even more efficient labour market than before the pandemic, which feels like maybe a little bit of a stretch, then that's something that's run its course. I think the participation rate has probably peaked, and even there's actually evidence of that starting to struggle a little bit and come off its highs. We know the US has demographic challenges, so an aging population is consistent with a structural decline in the participation rate. So I think that's one too that has probably run its course. Bit more open-minded on the population growth and immigration dynamic. It's possible that has further legs to run, and that's something that could provide a bit of support too. And maybe on the productivity side, not impossible that you get a few more quarters of strong productivity growth. But if I wrap these things all up, I'd probably come with the conclusion that much of the supply side dividend or recovery is probably behind us. It would be my best conclusion.
Why don't we pivot to the demand side of the economy? Because among many other tailwinds, one for the US economy last year was fiscal policy. Can you give us a sense, James, of the size and source of fiscal expansion in the US last year?
Yeah, there was a hidden fiscal expansion last year. Partly because there was no sort of major new legislation passed, and partly because it was obscured by changes around the accounting on student debt practices. But if we sort of try and cut through those factors and look at the numbers, then we think the deficit broadly doubled from around 3.8% of GDP, which is large already, to around 7.5%, which is very, very large, especially outside of a recession. A few things behind that. One is relatively supportive government outlays, passed during the final sort of throes of a fully unified Democrat government. There were some lingering effects from the big pieces of Biden legislation passed earlier in his term, as you mentioned, the CHIPS Act, the Inflation Reduction Act, the Bipartisan Infrastructure Investment Act too. So that was all quite helpful. And then there were some quirks too. So things around the timing of receipts, markets doing very poorly last year, and the effect that has on income tax filings around capital gains, etc. We don't think that they're hugely consequential. But if we think about that, 3 to 4 percentage points of GDP widening in the deficit, and try and map that into growth implications, direct government spending and investment, we think that probably added around 1 percentage point to GDP growth last year. So that's probably taking up around a third of aggregate US growth. If we try and map some of those policies in infrastructure investment, the manufacture of semiconductor chips plants, the investment that's been facilitated and supported by tax credits in the Inflation Reduction Act. Structures investment in the US was up 15% year on year, which in an environment of very high interest rates is clearly an outlier. We probably attribute that almost entirely to those fiscal imperatives that added around 0.4 percentage points to growth. So you can pretty quickly get a very sizable direct government contribution to the economy, which undoubtedly provided pretty significant support.
And it is worth underlining quite how unusual a deficit of that size at this point in the business cycle is. I mean, it was sub 4% unemployment, at perhaps beyond full employment, and then having a further fiscal tailwind is unusual. I mean, another way of saying that is that the structural budget deficit is very large. But that tailwind might turn to a bit of a headwind in 2024, right, James? And what sort of tightening in fiscal policy are we talking about?
Yeah, I've penciled in. It's always difficult to forecast. I've penciled in a 2 percentage point of GDP tightening in the deficit. So that's a drop in the deficit from that 7.5% to around 5.5%. Again, that headline number is really large, and you'd expect that to be, in normal times, that would be a fairly meaningful fiscal headwind. I think there are one or two of those temporary factors which will unwind. Again, the timing of receipts just shifts into a different fiscal year, and that will benefit it. I think capital gains will be stronger given the market environment we had. So that's an additional form of income tax receipts as well. So once they figure themselves out, we look at the fundamental changes. Government expenditures are definitely going to be tighter. I think the Fiscal Responsibility Act penciled in around 60 billion cuts to non-discretionary defence spending. There's risks of shutdowns and further cuts to that if Congress can't reach agreement. So a little bit less on the government expenditure side. In our forecast, we've got that 1 percentage point of GDP growth contribution from government to shrink to probably around 0.5 percentage point. So not an outright headwind, but much weaker contribution from the government side. And then the structures investment side too, I think that's it's been very difficult to repeat the type of growth that we got last year from that channel. Even if structures investment remains at these levels, that implies very significant investment in that sector. So we think that will dry up as well. So you can quite easily pencil in a smaller contribution from the government angle of around 1 percentage point or 0.5 to 1 percentage point of GDP. So I think that will be certainly a less helpful tailwind to the economy this year.
Of course, much depends on politics here. So there's both a bill currently going through Congress that could change that fiscal picture a little bit, and of course, an election later this year in which everything could change again.
That's right. The Congress is struggling to get anything done, but has made some progress at least on around 110 billion worth of child tax credits and corporation tax cuts, which feels odd given the size of the deficit that we spoke about, where you sit in the current business cycle and the ability to do your basic fiscal homework around passing a budget, etc., raising the debt ceiling. All of that has been challenging. At the moment, we're not convinced that will get through, but if it does get through, then that would probably mean you get around another 0.5 percentage point, maybe a little bit less boost from the fiscal side to growth. So it would be filling up that lost growth that we spoke about for this year. And yes, then looking into 2025, we will have a new president, and maybe we'll have a new Congress, and I think that will be really important in determining where policy goes and where the deficit goes into the next term.
Well, so looking to that longer term horizon, James, there, and as you say, sometimes this lack of willingness in Congress to do the fiscal homework, and the sense in which the deficit is already very large for this point in the cycle, and maybe both parties have commitments that would see it increase post the election. I mean, there have been these concerns about a lack of political will to get a grip on the deficit, and so the long term path of debt. But I mean, how much of a worry really is this? And the rating agencies, several of them have downgraded US government debt, most recently Fitch last summer, to basically no effect. I mean, US interest costs have risen, but that's largely a function of policy interest rates. There was a bit of a concern the back end of last year about maybe rising term premia, which could reflect some concerns about government borrowing, but those have largely fizzled out. So, is this really a genuine concern? I mean, is it possible that there is something of a fiscal crisis, or is that concern misplaced?
I think there's a genuine concern. I think a fiscal crisis in reasonable-ish time horizons feels like more of a tail risk than something that should be really high up the sort of priority or the focus. But I think the public finances do look to be on for the very long term, an unsustainable footing. And we see that Paul mentioned earlier, that structural deficit, a structural gap between spending and receipts, that really needs corrective action. And as you say, there just doesn't seem to be the political will to address that, either through less spending or higher taxes. If anything, the political winds are just continue to push towards a reduction in the tax burden or increases in spending, depending on which party you're listening to. And even when in power, when power is shared, the easiest course of direction seems to be some combination of those where both sides win through those channels. So I think there's concerns that the US will continue to run sizable deficits. I think there's concerns too, reasonable ones, that the interest expense, the interest burden on the current debt is becoming more challenging to finance. We see that rise above 3 percentage points of GDP each year. That's the highest it's been since the 1980s. So certainly, you've got this combination of very high, we call it primary deficits, which excludes the interest cost, and then high interest costs makes for significant overall deficits. So our forecast, consistent with the CBO and other fiscal watchdogs, is that US debt just continues on its current path to drift higher. What would really be necessary, though, for that to escalate into a crisis would be, for markets to get very upset at that and stop financing that at current interest rates, so to permanently charge the US government significantly higher to finance that very large deficit. When we run those types of simulations, we could see the US debt burden rise from something between 110 to 120% of GDP under our current forecast to close to 150% of GDP over the next decade, which would be a very significant leg up, absent any corrective action. The good news for the US is it has this exorbitant privilege that there's a huge structural demand in the global economy for US treasuries, for dollar-denominated assets. And that seems to be, keeping a lid on and providing it with room to be fiscally irresponsible in a way that a lot of economies don't have that benefit. So I think the US in some ways, because of the role it plays in the global economy, is getting away with a really poorly managed and probably unsustainable fiscal policy. I just don't think that they'll get called on that, at least in the next sort of 10 years or so, or we probably should think about that as a tail risk and something to monitor as opposed to something to be really focused on around our base case.
All right, well, I think that is all we have time for this week. So as ever, please do let me remind you to like and subscribe wherever it is that you prefer to get your podcasts. And all that remains is for me to thank James for joining us this week and to thank you all for listening. So thanks very much and speak again soon.
This podcast is provided for general information only and assumes a certain level of knowledge of financial markets. It is provided for information purposes only and should not be considered as an offer, investment, recommendation, or solicitation to deal in any of the investments or products mentioned herein, and does not constitute investment research. The views in this podcast are those of the contributors at the time of publication and do not necessarily reflect those of Aberdeen. The value of investments and the income from them can go down as well as up, and investors may get back less than the amount invested. Past performance is not a guide to future returns, return projections, or estimates, and provide no guarantee of future results.